Hello, this is Bob Steele. In this lecture, we will take a look at Chapter 12, Accounting for Partnerships. So we'll start off with partnership form of organization. Partnership form of organization, we're going to take a look at the characteristics, and first off, we have a partnership agreement. So if we're talking about a general partnership, note that it's really easy to form a general partnership in that what generally happens is if we get into business and we start earning money and we are a partnership, then generally we have a partnership. So that could be an oral agreement. So obviously if we started doing business and we started making money, the partnership agreement could be oral. It's best practice to put it in writing because that will lay out the terms of the partnership. So a sole proprietor would be an individual starting to do business. A partnership would be two individuals or more coming together and doing business, and there should be some form of agreement. Be great to have that agreement in writing. That would be the good thing to do for many reasons, but note that if we just started doing business as a partnership, then we would generally be a partnership and we would have to basically recognize our income in some way. So we have the limited life, meaning that a partnership will have to restructure upon the leaving of one partner. So especially in the case, of course, if we have a partnership and one partner basically like died or something like that, then there's a limited life of the partnership based on the partners within the partnership. We have unlimited liability. That's one of the big issues with partnerships as well as sole proprietors, in that if there was a lawsuit or something like that, then not only is our assets that are in the partnership that could be up for grabs in terms of a lawsuit, but so could our personal assets, and that's the big risk with partnerships. So we have co-ownership of property. So we're going to put property together with at least two or more individuals and co-own it within the partnership, which means that both of those individuals have basically an agency agreement, whereas we can utilize those assets through our decision making as basically the partners in the partnership. So that means that we have agency rights over the allocation of resources of the other partner that has been pooled into this partnership agreement. Voluntary association, so the association with the partnership is a voluntary action. Taxation, partnership income is going to be taxed. The partnership income will generally flow through to the individual tax return, but of course any income that is generated is going to be taxable, is a taxable event. Again, partnerships are generally flow-through entities, so the taxation event will generally happen on the partners' 1040s on their individual income tax returns. And we have the mutual agency. So once again, we're talking about the two individuals who have agency, meaning when we're on a decision maker in a company or a partnership, we basically are making decisions on behalf of the company or partnership, meaning we're acting as the agent of the company or partnership. So when we do something and make decisions for our job, for our work, as far as allocation of resources, we're acting as the agent of the company, meaning we are doing what's hopefully best for the company. In this case, we've pooled resources together, therefore we're acting as mutual agents of each other's resources, which we have pooled together, and we can now make decisions on as partners within the partnership. Organization with partnership characteristics. So there are some variations to the partnership, and most of these have to do with liability issues. Remember, we said that the problem with a partnership is that there's liability issues, that if we get a lawsuit or something, the individuals could not only go after the partnership assets generally, but they can often go after the partner's assets. So not only going after the building we do business in, but maybe going after our house, right? And so that's one of the issues. Now, obviously, when a small company goes into practice, we may not have a lot of personal assets anyway, so smaller companies may be more willing to take on that liability, and it may not affect them as much. Of course, as we get larger or do more business, or maybe have more risk involved in both the business and more assets personally, we might be more inclined to find liability protection. And these are some forms that we can do that within the partnership umbrella. And now, notice the good thing about partnerships is that they're really the most flexible form of organization, meaning we can allocate who gets what much more different ways, in a lot of different ways in a partnership. Whereas even in a corporation, we're somewhat limited to the stocks, the way stocks happen, because we know that stocks in and of themselves mean that they're going to be all the same. In a partnership, we can have different people doing different parts of the partnership in terms of work. We can allocate the net income in different ways. We can allocate salaries in different ways. And so that flexibility is really great, and we can just put that into the partnership agreement. And it's similar to if we had roommates basically living together in a home. When I teach partnerships, a lot of people always say, well, they're partners, so everything should be exactly even. And in real life, everything needs to be fair, not necessarily exactly even. For example, if two roommates were going to college and they moved into a house together and one of the rooms was twice as big as the other room, doesn't mean you can't move into the house together. It just means that whoever gets the larger room is probably going to pay more, or they're going to be doing all the chores, or they're going to pay for the utilities, or they're going to, be the one that has to do all the dishes. As long as you come up with an agreement that everybody agrees on, that's fair, that is good. It doesn't mean that everything is even. So a partnership generally doesn't mean that everything is even. It means that things are fair. So one of the ways that we can break out the partnership is we can have a limited partnership. And that's where we're going to have a general partner assume management duties and unlimited liability of the partnership, while the limited partners have no personal liability beyond investments. So notice this is an uneven partnership by definition, and it could come about many times because one partner may be kind of an entrepreneur that wants to really build the business, and they may be looking for investments from another partner who really doesn't want to be involved in the business, but would like to invest in it, thinks it's a good idea to invest in it. The person investing does not want to risk any more money than they actually invest in the company. So if the investor puts in $50,000 into the startup, they don't want a lawsuit to happen and be liable for their personal resources as well. They just want to be liable for that $50,000 that they put up front. The person running the business would then take the more of the liability, because they're the one in charge of the business. So if someone sued the business, then the person running the business that's actually involved in the day-to-day operations is the one that would have more liability in that case. That's one form of limited liability, which is geared towards providing capital, making it easier for startup companies hopefully to get capital, because investors are more likely to invest if they have limited liability in terms of how much they invest versus their personal liability. We also have limited liability partnerships, and notice a lot of the partnerships that you'll see are going to be law firms, they're going to be CPA firms and other service companies, where oftentimes different lawyers, different CPAs, different tax preparers will get together and pool resources, and those resources that they're going to pool are going to be employees. It's going to be the software that they might need to look up research and stuff like that, the tax preparation software, paper, and that kind of stuff, the things they're going to pool. And so in reality, in a lot of these types of firms, the partnerships really have their own clients, and they're pooling together the resources in order to serve those clients. And in that case, if we have a limited liability partnership, then we can have an instance where if one partner has a problem and gets in a lawsuit, gets sued or something like that, the other partners are not responsible for that partner past the resources of the company, meaning they have some limited liability to their personal assets for the error made by one partner, or the liability that goes beyond in one partner, which generally comes from some kind of lawsuit or something like that. So that would be a limited liability partnership. And then we have the limited liability company. Members have some limited liability future as owners of the corporation. Limited liability corporations typically has a limited life. What that means is the new idea was that we're going to try to make a limited liability corporation, in which case we have the same kind of corporate shield in some ways, so that once again we're trying to safeguard the liability. If we get in trouble, they can come after the limited liability company's assets, but not generally the partner's personal assets. And notice that's one of the major reasons we incorporate, is that we're trying to oftentimes find some liability protection. But the corporation is often more costly, and it's often advantageous to have the flow through and the flexibility that we find in a partnership in these types of companies and these organizations. Therefore, the limited liability company is geared to have the best of both worlds, meaning we still have the flow through of, we have to file taxes, but the tax will actually flow through to the individual's income taxes. We still have the diversity in being able to make these different types of arrangements in the partnership agreement so that we can design it exactly how we want to make the partners happy. And we should have some liability protection similar to the liability protection we would have under a corporation. So here's a breakdown of those properties. We got a proprietorship, a partnership, a limited liability partnership, a limited liability company, and an S corporation. We haven't talked about an S corporation yet, and the S corporation was made in a similar way as the LLC, meaning that instead of being a normal C corporation, in which case you have to make a C corporation tax return basically, and the corporation gets taxed. And then when we give out the taxes to the individuals as dividends, the dividends are actually taxable. So then we have this form of double taxation. So the S corporation, similar to the LLC, is an option for companies that want to find liability protection, oftentimes for the most part, but don't want to have this problem of double taxation and want the income on their taxes to flow through from the company to the individual tax returns and be taxed in that way. So similar to the LLC, a S corp is like more close to a corporation, not quite as flexible as a limited liability company, a partnership type company, but has that same flow through feature to it. So if we take a look at the business entity, proprietorship, they're all business entities. Are they a legal entity? The partnership, the proprietorship is not basically a legally separate entity, meaning the company itself doesn't have legal properties such as filing a tax return or basically owning the property separate from the owners. Neither does a partnership. What that means is that their liability, that's why they have more liability problems, meaning they're less secure in terms of liability. And so same with the partnership. So those don't have the legal entity. Neither does the LLP. The LLC, the S corporation, and the corporation do, and that's what provides that extra level generally of some kind of protection. The limited liability company, does it have limited liability? Partnerships, once again, do not, basically because of this one up here. Neither do proprietorships or partnerships. Limited liability partnership has some, and remember what we're saying is that if one partner makes an error, the other partners have some protection against their personal assets for the error that the one individual made. The one individual has their personal risk to their personal assets if they got sued or something, but the others in the firm, the other partners, generally do not. Limited liability company and S Corp and C Corp generally have that kind of liability protection because we're saying that these organizations are separate legal entities. Therefore, if you sue a limited liability company or a corporation, you're suing the corporation. You're not suing basically the managers of the corporation, and therefore their personal assets are generally liable. Business taxed. So once again, the proprietorship, partnership, LLP, LLC, and S corporations are all flow-through entities, meaning that the actual taxation event, for the most part, happens on the individual level, and that's the benefit of these types of organizations in a lot of ways. That's kind of why these were set up, because it prevents double taxation in some ways, and provides some limited liability protection. Corporations, on the other hand, are taxed on the business tax, so the corporation has to file a return and pay taxes on it, and then any dividends that they pay out to the owners generally are taxed. One owner, that's only the partnership's going to have one owner allowed, the proprietorship, but not the partnership. The LLP needs two owners. The LLC, S Corp, and corporation, possible to have one owner.